It's actually my true privilege and honor to introduce Huma Mahadin, the Market President for BNY Wealth Management. We have enjoyed working with her and her team over the years, and she brings great personality and talent to bear, and Huma is going to introduce our speaker.
Hello, I'm Huma Mahadin, the Market President for BNY Mellon Wealth Management in Pittsburgh. We've been serving the Pittsburgh community for over 150 years in economic development and working with individuals, businesses, and nonprofits in their wealth management needs. I'm pleased to be here, especially because we have a very long-standing partnership with Grossman Yannick Ford in collectively working to service our clients, individuals, and business owners for their financial success. It's my pleasure to introduce Leo Grachowski, our Chief Investment Officer. Leo has over 40 years of asset management experience and helps us manage over $300 billion in client assets. He serves on our firm's investment policy and operating committees, and you may recognize Leo as he is a frequent guest speaker on media outlets such as CNBC and Bloomberg. Leo's going to talk. There's a lot to discuss, as you know, in markets. We have central bank tightening of monetary policy globally, inflation expectations and heightened inflation, slowing global growth, upcoming midterm elections, and so much more. So Leo is going to share our thoughts on those topics as well as investment implications for our clients and investors. So without further ado, it's my pleasure to introduce Leo Grachowski.
Huma, thank you very much, and good afternoon, everyone. Thank you for allowing us to be a part of today's agenda, which looks like a busy one. You had a lot of content to go through this morning and this afternoon as well. I just hope I don't give you indigestion after lunch, talking about the markets and the economy. Huma chuckled when she said over 40 years, because my bio used to say over 30. And then once I breached the 40 mark, they couldn't round down anymore. So I have been in the asset and wealth management business for 42 years now, sitting in the Chief Investment Officer chair for 28 years, including the last 15 at BNY Mellon. So as Huma suggested, my job at BNY Mellon is to oversee the investment process, the people that are responsible for making the investment decisions, and ultimately be accountable for the investment performance. I'm smiling when I say that, although it's certainly, as you all know, been a more challenging year. Through the first 3 months of the year, really an unprecedented year in terms of market performance. Since the aggregate indices on bonds were developed in the 70s, never before did we have a 3 consecutive quarter decline in both stocks and bonds at the same time, right? So the S&P 500 and what is now known as the Bloomberg Aggregate Bond Index, both down 3 months in a row, and that leaves you with a 60-40 balanced portfolio down 20.2% through the end of the third quarter. Obviously, October gave us a bit of a reprieve, but the Federal Reserve meeting yesterday reminded us that hope is not a strategy. And the hope for a Fed pivot is certainly why the market turned around yesterday. Today, actually, the market is, as of 12:59, market's essentially flat. The S&P's down a few basis points. Dow is actually up a few basis points. The NASDAQ is down about 60 basis points. Why? Because those asset classes that are longer duration, right, are feeling the pain of a Federal Reserve that said yesterday, we're going to look at the impact of monetary policy, but our terminal rate is probably needing to be higher than what you all are thinking. Okay, so on this morning's morning call at 8:30, Huma heard me talk about that terminal rate is now about 5.2%, right? We were trading just a day or two ago below the 5. So the markets are now pricing in about a 5.2, and the 2-year Treasury at 12:59 was trading at a 4.7% yield. Right, so we do have indeed a lot to talk about, a lot to adjust to. I've been in the business for 40 years, so when I started in the business, it was during the Volcker era where we had pins, whip inflation now, and I was very happy to be buying zero coupon, tax-free municipal bonds at 15%, right? Many people, probably in this room and certainly in the industry, haven't been through a period of rising inflation, higher interest rates, and what they do, right, to things like PE multiples, right? PE multiple in the early 1980s was 8 times earnings, right? Today, people are excited because the PE multiple is back down to around 15 or 16 times earnings. I'm going to start, and I'll take you through some charts and slides. Sometimes a picture's worth 1,000 words, even when they're not pretty pictures. And the first one is not a pretty picture. And in my 40 years of experience, there's a list of bad words for investors. This is one of them, right? Stagflation, right? What is stagflation? Obviously, right? Low growth, high inflation. And here's the snapshot picture of what we're dealing with. Right? So if you have clients saying, why are the markets, right? What's the problem? Why is the market down 20%? Here's what we're dealing with in one word, stagflation. Okay? Now the good news is this is a snapshot, right? Our view at BNY Mellon is inflation is peaking, right? In fact, as a result of yesterday's meeting by the Federal Open Market Committee, I'm increasingly convinced that our probability of recession of 70%, that's the BNY Mellon view. We think over the course of the next 12 months, there is a 70% likelihood that we're going to move into recession. I'd put an exclamation point on that now, right? And that might be on the low side. Consensus expectations going into the Fed meeting were around 60%. But again, you talk to people all the time. I did a roadshow with Dr. Ed Yardeni, who was on our call this morning. He thinks we're already in a recession, right? But no matter how you slice it, we are in a period of slowing economic growth and stubbornly high inflation. That's what has led to this unprecedented simultaneous decline in both stocks and bonds, right? Now, for investors that say there's really no place to hide, right? That's largely the case, but take a look on the far left-hand side of the equation, right? Commodities have done well, not surprisingly, in a higher inflation environment. Not necessarily gold, right? Gold is down about 11% year to date. Obviously, the energy complex, right, is helping that commodity performance. The US dollar, if you consider that an asset class, is up 17% year to date. That obviously has a lot of implications for earnings valuations. Most of the money that we manage for our US clients, it's dollar-based and it's unhedged. So we have been and remain underexposed to non-US securities, in part because of what this dollar has done, right, when you translate back in an unhedged equity portfolio. There are other asset classes, right? Just when you're ready to wave the white flag of surrender on alternative asset classes, right? This is a year that's a proof statement for diversification beyond traditional asset classes. We have a number of hedge fund managers included in our portfolio, macro managers, long-short managers, absolute return managers that are up on a year-to-date basis, right? So you want to look at assets that are able to exploit volatility intelligently, and we've found that in the hedge fund complex. So generally speaking, hedge funds have sort of done what they've been designed to do this year. They've held up much better as an asset class. Once again, it comes off a multi-year period of broad frustration. And by the way, when the S&P 500 is up on an annualized basis, 16.6% for the 10-year period ending December 31, 2021, why do you want to bother with these other things? Don't talk to me about hedge funds, private equity. I have to lock up my capital for 10 years. That rising tide of large cap US equities, S&Ps that you can get with index funds, made a lot of investors a bit lazy, frankly, right? I think this year is proving to be a wake-up call and a reminder that diversification is important outside of traditional asset classes, and after-tax, after-fee performance is going to be scrutinized, right? I'll steal some of my own thunder in concluding remarks. I'm still amazed at how many high net worth individuals and families in higher tax brackets don't take advantage of tax-managed equity strategies, where you can get index performance but actively harvest losses that can be used against gains in a portfolio, right? And if you don't have the gains this year, you could use them against gains in other years. But I still see a lot of large family portfolios with straight index funds, right, or ETFs, right? And for taxable portfolios, there are still many clients that should be considering tax loss harvesting. This year is a poster year for the benefits of tax loss harvesting, as I don't have to tell this group, right? And in addition to what we at BNY Mellon call TME, tax managed equity, there's also TMFI, tax managed fixed income, right? With bonds down as big as they are, including municipal bonds, one of the reasons you're seeing municipal bond outflows, despite what are now, I think, rather compelling yields, there's a lot of loss harvesting going on with municipal bond portfolios. But be careful about that, because the spreads between bid and ask in municipal bonds, which are always, wider than many bond asset classes like treasuries, are even wider this year because of volatility, right? So to do this on one's own with a single municipal bond or a fund, you're much better off doing this in a professionally managed SMA portfolio. At BNY Mellon, we're allowed to cross trades, right? We've got the OCC approval. It really helps the tax loss harvesting, right? So you have to be careful how you implement it. But equity harvesting, fixed income harvesting, this is a poster year for all of that. Volatility has fallen from its recent highs, at least until yesterday, but is still elevated. Those of you that may have listened to our BNY Mellon calls over the last couple of years, where we were in an exceptionally low period of volatility. What do you do with low volatility, right? You don't extrapolate it, right? You diversify and you hedge. Once again, this year, good year for diversification and hedging strategies, right? The VIX is not out of whack relative to what we're seeing in daily trading activity, and that still gives us an opportunity to hedge downside protection, right? That one might normally think you'd have to pay more for. So the volatility of the market, 50% of the trading days, we're seeing more than 1% moves. You have to go back to 08 or 09 to see that. And you have to go back to 08 to also see the number of trading days where we're moving 2% or more. So if you feel like this has been an exceptionally volatile year, it certainly has been, although it doesn't all show up in the VIX, and that does allow us to price downside protection and hedging a little bit less expensively than one might think inherently. Investor sentiment is one of the strongest contrary indicators that I've looked at for 40 plus years, right? It's kind of a sad comment, but investors, both institutional and high net worth, when we're all feeling the most optimistic thing about things, that's usually the 12-month period ahead that turns out to be more disappointing than when the reverse is true. Now, easier said than done, right? Because usually when we're all pessimistic, there's a reason for that, right? For the slumped shoulders. So right now we're in a period where investor sentiment has been really negative, right? And there was a poll that came out just yesterday by Bank of America that showed equity exposure, right, at levels that we haven't seen in decades, really low equity exposure, right? So it's counterintuitive. You want to see that very negative sentiment in order to say maybe this market has bottomed, right? Now at BNY Mellon, we've been very careful not to pronounce the bottoming of the market, even though sentiment has been very poor, because unlike the first quarter of 2020, we're not seeing big volume. There's not a lot of conviction out there. Now, the good news is many of our clients haven't been waving the white flag of surrender and saying, look, get me out. I'm about to get a margin call. I'm about to hit a high watermark on a line of credit, right? We're not seeing that just sell, I don't care what the price is, I need to raise cash. So there's a lot of negative sentiment, but we haven't seen that dreaded C word, capitulation, right? And usually, technically, we want to see, right, that I can't stand it anymore, and you want to see big volume, right? The volume of composite trading has been running at about 11 or 12 billion shares a day. Back in February, March of 2020, that was closer to 20 billion a day, right? When COVID started to rear its ugly head, right, you just turn on the TV and somebody say, look, I know the market's down 30%, it could go down another 30, right? Okay, get me out. Move me to cash, even though cash is yielding zero, right? So we're not quite seeing that level of capitulation, but the point is sentiment is very low and depressed, and that's usually a better entry point than it is an exit point. Business sentiment, and I'm sure you all feel this as we do, right? We have analysts covering companies privately, publicly, small, big, medium, and sentiment is pretty poor, right? So this is the small business outlook. I like to include that because that's an important swing factor for hiring, and I'll talk about unemployment in a minute. And part of the reason sentiment is low, part of the reason for all of these issues, as we know, is inflation, right? Is inflation. Very sticky, not only in the US, right, but globally. And the components of inflation that are driving that, this is very important, right? The housing market, which I'll talk about in a minute or two, showing a lot of signs of weakness, but it's not yet showing up in inflation indices like the PCE, Personal Consumption Expenditure Index, or the CPI, the Consumer Price Index, right? So here is the problem that the Fed and the central banks around the world, the Bank of England tightened 75 basis points as expected this morning. It's to fight this inflation problem. And here's the monetary tightening, right, that we've been witnessing around the world and that I just talked about earlier, where the Federal Reserve did 75 basis points and signaled more tightening until they get to a possible terminal rate that's now over 5%, right? So there's more to come. The good news that came out of yesterday's report, as depressing as that sounds, is they did talk about recognizing the lagged impact of monetary policy, and they're going to take that into account. And that's really important, right? Because the CPI, the Consumer Price Index, is not a leading indicator, right? It's at best what we call a coincident indicator, if not a lagging indicator. So you want to make sure that the Fed's just not looking at the CPI and say, okay, we've got a problem, right? Because we know the impact of these higher rates is taking its toll. It's just not showing up on all of the pricing yet. I will tell you that we have an office in Newport Beach, California, where I was last Friday. And when you look out on the Pacific Ocean, in January or February this year, you could see the ships, right, literally like a parking lot, one after the other, waiting to get into the ports of Los Angeles and Long Beach, about 40 or 50 miles away, right? There were over 100 of them waiting to get into the ports, right, earlier this year. Last week there were 4, right, 4. So a lot of the concern about supply chain is still with us, right, if you're looking at cars and things, but we've passed the peak in supply chain issues. That's the good news. The bad news is part of the reason for that, lower demand, right? Look at what the retail, there's lower demand, less requests for inventory. So the Fed is tightening into a weaker economy, and I worry day in and day out about the chance of a policy error, right? That just as the Fed left that punch bowl of liquidity out for too long in hindsight, they're now going to tighten, right, too aggressively and too long into an economy that's already weakening. And that's why you will read about a greater chance of not only a recession, but a potential hard landing. And obviously the global growth slowdown is affecting the US, including China, right? China's a mess, right? You still have over 10% of the GDP of China in lockdown mode, right? That's keeping a lid on economic activity, not only in China, but around the world. I mentioned earlier the extreme move in currencies, and again, a lot of times as dollar-based US investors, right, we don't think as much. Why has the dollar been so strong? I get this question a lot. Is it because we're doing such a great job with our fiscal policy that, you know, we're confident in leadership? No, the most important driver of currency moves globally are interest rate differentials on the short end, okay? Interest rate differentials on the short end favor the dollar because the US has been aggressive and being in a position to be more aggressive with monetary tightening than some of the countries around the rest of the world who don't have an underlying economy as strong as the US and do face more risk of more serious recession in areas like Europe, where we've got a winter coming with limited energy supply. Okay, so the dollar has likely done its thing, I think, and most of the strength in the dollar is behind us. But I do believe the dollar remains firm, particularly after yesterday's Fed meeting, because remember, it's interest rate differentials on the short end, and the Fed's going to keep at this. Other foreign central banks are going to look at every opportunity to take the foot off the accelerator of tightening because their economies are in a more precarious position. Okay? But this is really important when we construct portfolios because of the direct impact on performance, right? When the dollar is strong, how that negatively impacts performance. And obviously, we've seen an extreme move in yields. My goodness, right? lower for longer is now in the rearview mirror, right? It's going to be higher for longer as a result of what's been going on, and sort of with an exclamation point put on after yesterday's policy meeting. The good news, right, is we do every year a capital market assumptions looking out for the next 7 to 10 years, and we're doing that work now, right? We'll be hosting a webinar in a couple of weeks' time, and for those of you interested in 7 to 10 year outlooks and capital market assumptions, you want to tune into that. I'm proud of the work we do in that space. It incorporates both judgment and quantitative disciplines, and I can tell you that the white paper that we produce around that has not been a popular read in the halls of BNY Mellon the last couple of years, as Huma will attest, because as asset classes got more reasonably and in some cases richly valued, the forward-looking return assumptions, right, were more challenged. Nowhere was that more apparent than in bonds, right? When you're starting with a coupon of less than 2%, right, what's your upside in bonds? So the 40 in the traditional 60-40 portfolio was pretty much zero, and sort of forced us, right, led us to more diversifiers, or what our industry calls alternatives. Now, as we sit and do our capital market assumptions this year, we're looking at a 2-year at a 470. We're looking at a 10-year Treasury yield of a 420. And by the way, I can go out this morning and buy Lancaster County general obligation bonds tax-free at 4.15%. Right? I checked with our fixed income desk this morning. I said, hey, give me some tax-free prints here in Pennsylvania. Right? What are some yields? Pittsburgh Water and Sewers are at a 420 out 10 years. Right? These are good, solid. Pittsburgh Water and Sewer is a good, solid single A credit, right? It's not a triple A, right? But you can get a good, solid single A piece of paper at a 420 yield, right? That to me is not something I've been able to talk about for some time, right? So I think bonds are back to being a decent anchor to windward at minimum, and looking at forward-looking capital market assumptions, it's going to really help the outlook of a 60-40 portfolio at a time when many investors are waving the white flag saying, what did my 60-40 get me this year? It got me down 20, right? And again, fortunately at BNY Mellon, we don't have a lot of families into 60-40, right? But we do have a lot of investors over the years who've been questioning, right, why they're doing anything other than that, because a good old stock and bond portfolio led by stocks has done rather well. This is, the phrase regime change is sometimes overused. This is a year of regime change. Okay, the downside of those higher rates, great news for Lancaster bonds and Pittsburgh Water and Sewers. You can get over 4% tax-free. Bad news for mortgage, right? We hit a 7 handle on mortgage rates, and not surprisingly, take a look at what that's done. Existing home sales are down 8 months in a row, right? 8 months in a row. Pending home sales are back to levels that we haven't seen since the height of the pandemic, right? We are in a housing recession, right? And the only thing keeping pricing elevated and inflation stubbornly high, inventories are still pretty low, right? Now they're working their way up. In 1 month, the supply of existing homes for sale went from 2.6 months worth to 3.2 months, right? And that's going to continue to climb. But anything less than 5, as many of you know, is considered a tightish housing market, right? So you still don't have the supply out there, but it's building, right? And it's going to continue to build as sellers say, wait, I'm not going to take that price on my house. And buyers are going to say, whoa, wait, I've got to finance that at 7 now, not 3, right? So I think housing is going to be stuck and slow for a while. Ultimately, right, we just saw for the last 2 months in the Case-Shiller numbers, prices roll over. They just started to roll over, and I think you're going to see more of that, right, as supply comes on and the housing recession, right, gets worse. We've seen overheated markets, right, just cool, right? I don't think we're going back to 2007 in terms of home prices nationwide declining over 30%, but I do think we're likely to see a 5 to 10% pullback in home prices, right? So that's been an important part of our view. The housing-related prices in the CPI are about 1/3 of the index, right? So if you disagree and think housing is going to remain strong or reverse this trend, then inflation is going to be even stickier, right? So we're encouraged that the Fed is saying we're going to look at the impact of these higher rates on things like, right, housing. And when they do that, I think in the months ahead, you're going to see more of an impact on prices than what we've seen so far. Only 2 months worth of price declines. And I do this because I always think of graphs, and it's just a little bit of a hook. You know, it's just a little bit of a turnover. But I think we're going to see more. Job market. We're going to get an important report tomorrow morning. It's probably going to show still about 200,000 jobs getting created, right? So the job market is still pretty tight, right? We are starting to see the job market loosen up, but we're going to take a look at tomorrow the average hourly wage gains. That's really the important number that we and the Fed are going to look at. They've been cooling. Average hourly earnings are running at about 5% year over year. Now, only down from 5.2% 2 months ago, but we're going to look for continued, right, signs that the wage pressures are cooling, right? Part of the challenge on employment, as many of you know, it's structural, right? So the labor force participation rate is still running not only well below where we were pre-COVID, but well below where we were 15 years ago, right? So just to put some numbers on it, the labor force participation rate 15 years ago in our country was over 65%. Today it's about 63%, right? Doesn't sound big, but that's a lot of workers, right? So we do have structural issues, right, leading to a lower labor force participation rate, including demographics, the aging of the population, right? Shorter term, I do think you're going to see more people looking for jobs as some of the stimulus checks wear out. And when you look at the consumer balance sheet overall, right, there is a lot of spending that's gone on the last couple of quarters where post-COVID, how many families do you know that said, I don't care what the cost is of that plane ride in that hotel, we're taking a family vacation this summer. And I don't care what the cost of that beach rental is, right, we're going to do that. And it's starting to show up in a declining savings rate and, right, more financing. And if you're financing stuff on credit cards, right, with rates doing what they're doing, I think you're going to see the consumer continue to cool down. Therefore, leading to, you know, more demand for jobs, improving labor force participation rate. But an important number coming out tomorrow morning on employment. So, we try to keep our slides updated. I know I drove the meeting planners crazy, right? Because things change so quickly. This is one I couldn't update through last night's close, right? Because now, as I said earlier, we're looking at over 5%, right? We're looking at over 5% on the terminal rate expected out of the Fed. And I talk a lot about stock market volatility, but we joke a lot at BNY Mellon with our bond team. The bond market has been as volatile, if not more so, than the equity market, right? Which is the point of this slide. All right, equity valuations. Okay? I would love to be here and say, you know, after a 20+% decline, you know, stocks are cheap, you got to get in there, right? This is a time to do work from the bottom up. There are a lot of securities that have been painted with a bear market brush that look attractive from what we call the bottom up. Stocks trading at PE multiples of 10, 12 times earnings with yields of 3, 4%. Our compliance department would get mad if I mentioned those individual stocks in front of such a large group. But bottom-up work, some good individual securities. At the overall market level, you know, the market's still not inexpensive. Kind of speaks to my comment earlier. The good news is we've dipped down to a 15 or so multiple on the market, right? Down from a 20+% earnings on the market, but multiple on the market. But here's the problem. I think earnings estimates are still elevated, right? BNY Mellon thinks that for 2023, the S&P earnings will be somewhere in a range of 205 to 215. Consensus is coming down, right, but stands in the high 230s, right? So if you believe, as we do, that there's more than a 50-50 chance of recession, 70% in our case, I think earnings are still too high, right? So that multiple of 15 on the market is using consensus earnings, and I think the multiple is still more demanding, right, if you take into account our earnings forecast. So again, some good opportunities from the bottom up, right? This is not, we think, a time to bail, right? It's one of those periods where, you know, it's too early to buy and back up the truck on an overall level, but certainly too late to sell, right? Too late to sell. But certainly at individual stocks, there are a number of opportunities. All right, you all know this, but I think I always find these numbers, rather staggering. When you look at the S&P 500's annual return, going back to 1995, if you miss the five best days out of all of those years, you give up almost 200 basis points of performance. Is that incredible? I mean, I've been at this for 40 years, and I still find numbers like these incredible. And one thing I will tell you, 40 years of being in the role, these days come when you least expect it, right? I could do a lot of presentations that are, who would have thought, right? Who would have thought? And often it's, who would have thought the market would rally 8% in October, right? Think about the end of September, we're going through these statements. So you do have to be prepared. And if you're representing intermediate to longer term oriented investors, right? The danger of market timing, the desire to monetize losses at exactly the wrong time. I've been chairing panels in behavioral finance and behavior. I've sat on the committee, as Huma said, overseeing BNY Mellon's pension and 401k plans. So I see the 401k flows, and you just get so frustrated when people are chasing the white dot of performance, right, and buying the 5-star funds after they've been named 5-star funds, right, and selling, right, when markets are down 20% and 30%. And I've had to talk CEOs, as I'm sure many of you have, who are used to managing businesses off the ledge of selling at the wrong time, right? Because in investing, unlike managing a company, when you have a problem managing a company, what do you want to do, right, in managing that company when you have a problem? You want to remediate the problem. What does remediating the problem mean? It often means exiting a business or terminating an employee. And in investing, very often, that's a time when you can't stand it anymore where you want to double down on that business, right, or double down on that employee. Now, you don't do that willy-nilly, but this is what the successful, truly long-term investors have done over time. Think Warren Buffett, right? Warren Buffett doesn't have to march portfolio managers through board meetings where they're called on the carpet after 2 bad quarters. Right? Because what is a really hard thing to say when you're in front of a board explaining bad performance, right? When they say, Mary, what are you going to do to correct this performance problem? How are you going to remediate? It's hard for Mary to say, I'm going to keep doing exactly what I'm doing, right? In fact, I'm going to do more of it. But often in investing, that's what we have to do. And it's harder, especially now. When I broke into the business, we had common trust funds valued once a quarter. And I often think that was better for intermediate and long-term oriented investors. But now when I do a presentation at 4:01 p.m., everybody knows what their portfolio's worth, what the market did. And it's hard to not want to take advantage of that information, right? Some of the biggest challenges we have are with our large families who don't really need to create more wealth. They just want to preserve the wealth that they have. And they also tend to be very smart and plugged into what's going on in the world, right? Think about, right, before this year, if you had a lot of money and were interested in just preserving it and you just were plugged in on what was going on in the world, some of my colleagues have heard me use this analogy, and you went to sleep for 10 years and you woke up, you would have thought, thank goodness I kept my money under the mattress or in treasury bills, right? Because who would have thought geopolitics, COVID, the list of problems goes on and on. You would have never thought you'd have a 16.6% 10-year return in the stock market, right? So it's often very challenging, right, when you have clients, business leaders plugged into what's going on in the world, right, and having a problem that they're used to remediating, saying, wait, now's not the time, right? I've never believed in automatic sell strategies, right? Put in place, something goes down 20%, we automatically sell it, right? I grew up as a stock portfolio manager. Really silly, right? And you understand the need to check, all right, wait, something's down 20, what's my investment thesis? But to have an automatic sell, right, Warren Buffett would laugh you out of the room, right? That's sometimes a time to enter into the market. So the dangers of market timing, I have to remind people more now because we're not there with capitulation, but we are getting just a lot of concern after 3 months of poor statements. How much longer does this go? I'm retired, I don't really want to go back to work, right? And now would not be the time, in our view, right, to sell. We're looking more at when can we say it's time to get back in more meaningfully? And we're already seeing that in individual securities. I was amazed. About a week ago, we did a conference call, and we had about half the attendance that I thought we might have, featuring Wall Street's #1 ranked policy analyst, Dan Clifton, who joined us on a call. And I don't know, a week or so ago, there wasn't as much focus as I'm feeling now that we're less than a week away on the midterms, okay? Here's what I think leans to the Republican side, right? And I use a lot of Dan's work. I'm not a political analyst, but it's important because we get asked all the time, what would be the impact of the election result, on the market, right? So right now, our belief is you've got just about a 90% chance, right, of the Republicans taking over the House and about a 60% chance of the Republicans taking over the Senate. Some important races like the one you have here, where, by the way, if the Republican wins the Senate, right, it'll be the first time in 40 some odd years where you have a split ticket, right, assuming that the governor race here goes Democratic, where there seems to be a strong lead by Shapiro, right? But on the Senate race, which many say is too close to call, that would represent the first time in many decades where you'd have a split ticket, right, if Dr. Oz goes on to win. So the Senate's a close call. We'd give it a 60% probability. The betting odds, right, when you say, well, what does the market think? The market thinks today, according to something called Predict It, which is about the best market-based indicator of election results, that's at a 70% probability of the Senate going Republican. We think that's a little high, so our view is 60%. And again, the House looks like it's close to a lock for the Republicans at 90%. What does it matter for the markets? It's always interesting to look at the different combinations and permutations of the impact and the makeup of Congress and the presidency on the market performance. And you can see we've kind of lived through one of the lower return environments where we've had a Democratic Congress and a Democratic president. And I leave it to you to look at the rest because, again, this is nonpartisan. And I think broadly stocks are nonpartisan, but there are some different combinations and permutations. The Democratic Congress with the Republican president, right, is one that turns out to be least effective. I think more importantly will be the impact at the sector level. And that's the work that we do, right? With more odds of a Republican sweep, you're seeing, and I think we'll likely continue to see sectors like the energy sector perform better, right? You're likely to see the drug sector perform better. I leave it to you all to talk about the likelihood of tax policy change, right? Which obviously, in our view, right, isn't as significant under a red wave, right? So that's really the impact that we need to look at the election, not the impact on the market. I think if the election were held, tomorrow, and it was in fact a red wave, you'd get a modest uptick in the market. But based on those predicted odds that I talked about earlier, a lot of that is being discounted in the overall market, not necessarily at the sector level. I also think the finance sector does better. The sectoral beneficiaries are drug, biotech, finance, energy, and obviously aerospace and defense, right? I think those are the sectoral beneficiaries of a Republican sweep. Here's how we're positioning portfolios, okay? I know this is a busy slide, but all of these charts and slides have been approved and I think handed out. So consider the neutral, where we would be in line with our 7 to 10 year forward capital market assumptions, and consider overweights and underweights, what we think over the next 12 to 18 months. So you can see we're sort of neutral on our equity exposure, and as I mentioned earlier, we've been underweight outside the US, primarily due to that strong dollar that I talked about. We favor the U.S. in an overall equity portfolio that's neutral. We're still modestly underweight fixed income, but we did move our diamond to neutral as the 10-year Treasury yield exceeded 4%. And as I mentioned earlier, when you can get a 4.70 on a 2-year, I think you've got to be at least neutrally exposed in your Treasury portfolio. I talked about tax-free, right? If I had to redo these diamonds today, I'd probably nudge that forward, right? I think you've got a unique opportunity to own 10-year tax-free municipal bonds at or around the same yield you're owning 10-year treasuries, right? And part of that is due to that tax loss selling that I talked about earlier. And what our industry calls alternatives, we call diversifiers. You can see here that in most of those, we've been at least neutrally exposed, but obviously positions in absolute return hedge have helped. Private equity, we think, is going to withstand very well, but we're going to have to watch the marks very carefully in private equity, right, in the quarters and years ahead, right? Private equity is sort of hanging in there, but in the coming quarters, we're definitely going to see some lower marks, as you all know. But that's been an asset class that has treated us very well, and we do remain with a small overweight in private equity. All right, as I need to wrap, key takeaways, right? So if you needed one slide to take away, this would be it. Obviously, we have a global growth slowdown, and that unfortunately globally is accelerating, and it is accelerating in the U.S. as well, albeit not at as significant a pace. Our August investment commentary at BNY Mellon that we put out at the beginning of the month was entitled, "Hopes of a Fed Pivot Premature." And I joked at our Monday morning meeting this week that after the Fed meeting, we're probably going to have to dust that off, and here we are, right? We're similar to Jackson Hole, although to a lesser extent, the Fed reminded us that we're not in a position yet to pivot, right? We're going to look at the data, but we probably, in fact, have to continue raising our rates a little bit higher for longer. We do think volatility is going to persist, right? Take advantage of a VIX that doesn't price in all of that daily volatility and think about hedging strategies. We call buffered equity solutions, right? Where upside downside capture for new money is actually pretty attractive right now, right? You're able to put in structures where you can be protected against a 10 or 15% decline on the downside, capture the upside for the next year and a half up to about 25%, right? And get some leverage in between, right? We're able to do that, which is kind of surprising, but part of that is because the volatility of the VIX isn't as high as one might think it should be given the daily volatility in the market. I talked a bit about equity valuations. Good news, not as stretched, but we do think more earnings downgrades are coming, right? So we have to be mindful that valuation is not inexpensive relative to our 2023 outlook for earnings. The midterm elections, right? It's been amazing to see a cycle where it looked like, right, a red wave until the summer and Roe v. Wade, right? And then it was kind of a Democratic favor. And now since Labor Day, it's been back to a focus on inflation and the economy and the probabilities that I gave you earlier. But, more can happen between now and Tuesday. Stay disciplined, stay broadly, fully invested. That doesn't mean in stocks, but cash is more attractive right now. But when you can get 4% plus tax-free out 10 years, that's pretty attractive. I like to remind investors of the 3 Ds, right? What is discipline? Discipline is rebalancing, right? I see many portfolios that got lazy with rebalancing because the stock market was doing really well. And why would I want to put my money into some of these other things, right? So discipline, rebalancing. Diversification, again, this year being a poster for it. And the third D, due diligence. Another area where we have 18 people who do nothing but research and due diligence on manager selection, and 3 who do operational due diligence. Our industry gets a little lazy when the rising tide is lifting a lot of boats in both public and private markets. I think it's going to be really important to have providers who are doing that research and due diligence on the bottom up, particularly in some of those alternative asset classes, right? Hedge funds, private equity. And then finally, as I said, there's always opportunities being created. This year, I think, is an opportunity for tax loss harvesting, right? And to remind our clients that tax-managed equity and tax-managed fixed income investing makes a lot more sense for many than just straight indexing on a taxable portfolio. Okay? So I want to thank you for, again, having us today. I don't know that we have time for questions, maybe 5 minutes for questions, and happy to take any. Yes, sir. Let's let a mic find its way.
The spread that you were showing between the treasuries and the municipal bonds, is that tighter than normal, or is that normal?
It's a really good question. It is now moved to attractive again, right? It's a little wider than normal, only because of what's happened the last few weeks, where the muni outflows have really picked up, and the muni outflows have created some of these yields. So that 100% ratio, right, of munis to treasuries on single A and double A is pretty attractive historically, right? But not way out of the range, But it's a good question, right? And it depends on the point on the curve, and obviously what state you're in and what credits you're looking at. But spread, I hate to use the word product, spread product in general looks much more attractive, but high yield, the high yield asset class is trading 550 over treasuries, right? It's a pretty compelling place to find yield, but you've got to now overlay, in our view, a 70% probability of recession, so you do need to do the work. But many states and municipalities, I mean, look, the state here, you've got a good solid double A state, even though you've got a pension, many of you know, pension funding ratio that's below average, you've got some issues. Most states are in pretty good shape, as well as municipalities. So when we do the work bottom up, the chance of default, right now looks generally low, but in the quarters and years ahead, you just have to do the work on the individual securities, right? Lancaster, as an example, is a low single A. I know it well. My family lived there for many years, my mom and dad. But it has some insurance on that issue that I mentioned earlier, that this morning is trading at a 4.15 yield, right? All right, well, thank you all. Oh, we do have another question, sorry. And whenever time runs out and you get that last question, it's the zinger, right? It's going to be, no, I'm just kidding.
Do you feel that ESG has an impact on this market, or is impacted by this market?
It's a really good point. And I think what's going on in the whole ESG space, which we call RI, and actually we just hired this week a new head of what we call responsible investing. It is here to stay. I think the impact net in the work that we've done is positive if you do it the right way, not through simple screening, right? It'd be great to, and this is what the industry is going through. Many were wanting to say, look at the good work we're doing in ESG, we're checking the boxes. And it's kind of like that research and due diligence that I mentioned earlier. If you're doing it the right way, it's value added, right? And more importantly than value added relative to an index, it's what you're doing to meet, at the end of the day, we're here to meet client objectives, right? We have over 300 wealth managers around the country, and I like to say, if it was all about implementing a model portfolio at a point along a frontier, we wouldn't need 290 of them, right? It's about customizing for clients. So all the client meetings I do, if the first generation doesn't care as much about it, that next generation sure does, and they want to know what we're doing, right, to be responsible investors. So anyway, it's a really good question. I think the industry, some of the industry deserves to be back on its heels a little bit, because they really weren't doing what they should, what they said they were doing, right? And that shouldn't be rewarded. That should be penalized. Okay, thanks again, everyone. Been a pleasure to be a part of the program. Enjoy the rest of the day.